let me explain this new little project. There's a new little project underway by SARS. And I've given you, in your notes, you'll see. Just hope I took out all the reference numbers. But there's our little letter to SARS following the audit, and I'm going to explain everything to you now, all right? And the reason why I've given it to you in black and white was this is a precedent. They've accepted 25% tax rate across the board on these for us. So that's a precedent. If they accept it for us, they've got to accept it for everybody. Okay. So basically what the gist is, all right, we had a meeting. They called us into a meeting. Because what has been happening is, it's under TRM letterhead. You got it? Okay. And if you look at consultants, you see my name down there, so I can use this. It's our own stuff. Right? Okay, basically we have a situation, and I'm sure you're all aware of it. A thing called reimbursements. Now we talk about travelling allowances under section 81B 1, 2 and 3. 81B 1, you can read through all that. I'm going to give you the nuts and bolts of it. You don't have to go through everything now. But basically 81B 1 says to you, when you travel from your place of home, your residence to your work, it is private. We all know that, okay? Section 81B 2 says you can pay a person a travelling allowance. All right, that allowance to be calculated based on anticipated business mileage through the year, and that typically is your amount that you work out to being the fixed amount per month, 5 grand a month, 10 grand a month, whatever it is. Okay, that is code 3701. Okay, we all know that. Okay, nothing new. Then we get 81B3, which deals with reimbursements. It says where a company is reimbursing an individual at a fixed rate per kilometer, where that person has traveled for business purposes, that is seen as a reimbursement. Okay? In terms of the definition of remuneration in the 4th schedule, it says we are required to take section 81B2, which is our 3701, and either tax it at 20% or at 80%, depending on the circumstances. We're all aware of that. However, any reimbursement that you have made in terms of section 81B3 is excluded from remuneration, meaning we don't pay PAYE on it on a month-to-month basis. Whether that be at 15 Rand a kilometer, or whether that be the gazetted rate, what's that now, 3 Rand something, 3 Rand 16, or whether that be for 20,000 kilometers, or that be for 5,000 kilometers, it is still a reimbursement and is effectively PAYE free. Okay. Yeah, but that's where the codes come in, which I'm coming to now. Okay. But in terms of the Act, you can pay a person any amount. All right. Now we come down to the stupid little thing called codings. Okay. Where effectively it says, if an individual is below 8,000 kilometers and is below the gazetted amount, that code is 3703. Okay. What does it mean? 3703 means that you effectively are not required to substantiate to SARS, and that amount is deemed to be tax-free on assessment. If it exceeds that amount, or effectively if the amount is above the 8,000 kilometers, or the person who's receiving a travelling allowance, it must be coded as 3702. All right, which means the person will still have to, on assessment, put the travelling allowance plus that together and work out their normal claim to determine whether or not it's going to be still tax deductible, or if they have to pay in. You're all following what I'm getting at you, okay? But the Act doesn't say that to us. So a lot of companies out there had gone along, and also you don't know. I mean, the guy's got a travelling allowance, or he doesn't have a travelling allowance. In the beginning of the year, for the first 3 months, he doesn't have a travelling allowance. You pay him a reimbursement amount. That reimbursement amount is below the 8,000 kilometers, below the government gazetted amount, so you show that on a pay slip as 3703. All of a sudden, month number 5 in the tax year, he gets a travelling allowance now. So now you code that as 3701. So when the IP5 comes out, it shows 3701 and 3703. What's supposed to happen in terms of the Act, and what's supposed to have been done by efiling, which is now only being corrected, they were supposed to then, as soon as you get a 3701 and a 3703 or a 3702, you needed to add those amounts together and put in your claim, because that's what the Act says to us. Their system couldn't do it. So up until 2013, they were unable to do that. So now SARS has picked up, now this is a problem, because theoretically the individual's ILP5s are then incorrect, because the statement that you have made to SARS is technically not correct, because you should have shown it as 3702. Now, they're not going to go through for every single one of those individuals and effectively raise an assessment. Why? because it becomes a headache. So then they come up and they say to you, fine, this is where we found the problem. Has there been a loss to the fiscus? The answer is yes. Because if I claim, because the only thing you've taxed me on or made me do representation was on my 3701 travelling allowance. But you've kept that 3703 as tax-free. Where theoretically it should have been added together. You're all following. Okay? So there's been a loss to the fiscus because the individual hasn't been assessed correctly. So SARS says to us, guys, this is where we have the problem. We'll give you two options. The first option at the end of the day is that you as the employer need to go back and change all the IAP5 to show that it is correct, showing it correctly. Okay? And you have to get every single one of your staff members to redo their assessment so they can be taxed on the right amount. That's option number one. Now, does that sound like something is going to happen? No. So we'll give you option number two. Option number two is we will work out what the difference is that should have been taxed in the sense of what the amounts that weren't taxed under those codes. And we will raise 25% PAYE on the company and we'll call this matter closed. That's option number two. So which option do you take? No. See, now this is where the tissue box squad comes in. Because they're not going to believe that you didn't do anything wrong as the payroll administrator, because that's what the Act says to us. The fact that SARS' system couldn't see the difference and the interpretation of Section 81B, 1, 2, and 3 and add the amounts together, now it is being seen as your fault because you're the employer. Now you must go and change all those IAP5s, which means that you have to then go to each individual and say you're going to have to redo your tax return. First thing I'm going to say is why? Because SARS said so. Why? Because the IAP5 is wrong. Why? So how much else is wrong? Let me go. You know the whole story, okay? The nightmare behind it is not going to work. So now they say, well, option number two, you just give us 25% of the amount that hasn't been taxed for PAYE. Can you find that in an Act? No, because remuneration specifically excludes reimbursement payments at the end of the day. But once again, from a bigger picture perspective, and this is what most corporates are doing and most clients at the end of the day, we are taking option number two. Okay, but at least it's 25%. And all these individuals that I was dealing with in this matter earned the 40%. Right, do we get it as a tax deduction? That's the next question. The 25% PAYE that you have now paid over to SARS, do you get it as a tax deduction? The answer is no. Why? Not as a fine. Paragraph 5.5 of the 4th schedule says, any amount of PAYE that you have paid on behalf of your employee, which is not recovered from that said employee, is not allowed as a deduction. Okay, so you're paying 25%, plus you're losing out on your company tax rate on that amount that you have paid. So that's a new little project that is currently being run by, I know Large Business Centre has started it, and as soon as Large Business Centre starts it, it will flow through to everybody else. Take option number two.
What is the effective date?
The effective date of?
To pay the 25%.
Or when they raise the assessment, as normal.
No interest.
No, you got to do. No, the question is, what's the effective date of when you have to pay 25%, and is the interest or whatever? No, the interest is there. Okay, so it's raised in that aspect. But what you can do is, you can also say to them in those circumstances, then you raise it as at the last date. So in other words, February 2013, even though it relates to the last 3 years behind that, and then you reduce your interest like that. But you have to still make representation with regards to penalties and interest and all the rest, which you will see in this document anyway. Representation on administrative penalties and everything else is in here. So if I pick up an objection or a representation and it looks the same as this, then I know you've copied it from us, okay? But it's fine. There's enough pages on there, and you can see how many pages we're going on. So for that whole thing, it's like 8 pages, okay? And the penalty and remittance and all the rest is about 5 pages of that, all right? Okay, so that's the new project in place. Be careful. I must say, from the 2014 tax year, SARS' e-filing system has now been corrected. So in other words, if that happens and you put it through, it will automatically pull the amounts together and it will be assessed accordingly. All right, then it's not your issue. The reason why they get away with it is theoretically you as the employer have committed an offence. Why? Because you have not declared in the proper format, under the right coding, what the individual actually received. So instead of going that way of having this offence hanging over the company's head in terms of that, which they could pursue at the end of the day, take the payments and get everything done. Also, it protects your employees then, because what you need is confirmation that the employees will not be reassessed, because that's the worst. You pay the 25%, get everything fixed, and then your employees get nailed on an assessment at the end of the day. So that's something you need to bear in mind. Okay. Is there any questions so far? So. Yeah. Yeah, no, that's not applicable then. Yeah. It's only when there's a combination with those. The question being, is it only for those with a combination? Yes, it is only for those. And only the difference between what wasn't shown then as taxable at the end of the day. So it's not significant in the bigger picture of things, but it's still a pain to go through the whole process. Okay. Is there any other questions? Yes, ma'am. The question is, how successful, how big is it? The company I represented here was $3 million. So if you take, no, 3 million was a 25%, yeah. Which is, you'd be surprised how much money can be collected in these little projects. I don't know if you all recall the project that was done in 2006. You know, on Discovery, we all belong to Discovery, and well, 90% of people belong to Discovery. You know, you've got that little thing called Vitality for your gym and your movies and all the rest of it. 2006, Kirby Kemp from Megawatt called in every single large business center client that was with Discovery in an auditorium like this and said to them, guys, we know you've been claiming the Vitality as a medical expense. It's specific, excluded in terms of the Medical Schemes Act. So go do your list, work out the amount, and give us the money. I don't know how much in that aspect, but it was in the 100 millions. See, it's easy money. And you don't want to go through the fight. So yes, those are quick sells. So that's a new project in place. But we never know how much money they really make, but as I said, it's a lot. I mean, this little project alone, if I look at the numbers in large business centers at the end of the day and the kind of clients they're going into, the 3 million on this one is pretty much standard for most of those. So, I mean, it's significant, you know, in the bigger picture of things. Okay, anything else on that? All right, so, now we're going to do some case law. How's that? Are people really bored? Okay? So, we're trying to change things a bit, you know. This case is very important. Okay. I'm not going to bore you with every single line item. But please, when you are bored or suffering from insomnia, please go through this. There's things in here that are effectively going to come forward, and bearing in mind, how can you preempt what areas or industries or what kind of things SARS are going to be looking at? If you look at the recent cases, it'll give you an idea as to where they're going with this. Now, basically, this judgment was issued on the 5th of September this year. Okay, that's like not even 30 days old, all right? And basically it relates to a period of March 2003 to February 2008. Okay, but what does it deal with? And bearing in mind that's common, eh? You might look at me and say, but geez, it's 2003, 2008, and we're only resolving in 2014. That's how it happens when you land up in court matters. That's why you don't want to get to court, you just want to avoid litigation and get down to agreed assessments at the end of the day. Because obviously this is going back so far. But it all had to do with a little thing called salary sacrifice. Do you know about salary sacrifice? Is it allowable? Yes. Okay. This is one of the tax avoidance, Duke of Westminster versus Inland Revenue. Every man, and this is direct from there, every man is entitled, if he can, to order his affairs so that the tax attaching under the appropriate act is less than it should be. If he succeeds in ordering them so to secure this result, then however unappreciative the commissioner or his fellow taxpayers may be of his ingenuity, he cannot be compelled to pay an increased amount of tax. How's that, eh? And that is law. Okay. So, salary sacrifice is 100% allowable. However, the rules and regulations surrounding these is where your problem comes into effect. Why? Because what is human nature? We want our cake and we want to eat it. We are greedy. That's the problem. I mean, we stopped even advising people in 2002 already about salary restructuring, because it's all fine and well for the first month, and then thereafter, no. And where does the problem come in? Because now this is how salary sacrifice works, and anybody can do it. Give you an example. This is the case that happened here, where they messed it up, where they could have done it correctly. So now I want a company car, because the traveling allowances aren't beneficial for me anymore. And if you start doing sums, you'll see in a lot of instances company cars may be beneficial. But the company certainly doesn't want to go out there and create an additional overhead expense for them by giving you a company car, number one. Number two, how long do people stay with companies these days? 2-3 years? So in other words, I'm going to Avis fleet outside, because I'm certainly not going to drive your pink Mini that you left behind as a company car, okay? So I want another one. So companies are looking at process saying, yes, we can see the benefit, but we don't want the responsibilities. So what do you do is, let's say, and this is the legitimate way to do it, which is contrary, and they made a mistake in this case, and that's why they lost it, and I'll tell you why. So let's say my package is 240,000 Rand a year, okay? 20 grand a month. I want a company car. And that's really difficult on it, but just bear with me here, okay? 20 grand a month. Now, what I agree with my employer is, I will effectively give up 3,000 Rand of my money per month, making my package 17,000 on the quid pro quo basis that the company will supply me with a company car. So what happens is the company takes my 3 grand, equates that to a yearly basis, call it 36,000 Rand, and that is in my account. Call it my kitty. This is how we balance things out. And they go and rent a car for me. Alright? The rental value is your taxable value from a company car perspective. So in other words, let's say the rental's 1,500 Rand a month. So that 1,500 Rand a month comes out of my 3,000 Rand, and my petrol cards, my repairs and maintenance and everything else comes out of that 3,000 Rand. And if I'm over, I have to pay in with my after-tax money. And if I'm under at some time during the basis, the company can then say, fine, here's a bonus, or we just carry it forward to the next year. Okay? I'll be all with this. So now I've given up 3 grand, I'm getting a company car. So my package theoretically is changed. Now, where the correct procedure comes in is you firstly need to, and there's court cases about this, but I'm not going to go into that detail, but principally what you need to do is you need to agree to it. But now all of a sudden, when my bonus is worked out, what's it worked out on? 17. My pension provident fund contributions are based on 17. Now this is where the problem comes in, not so much from the admin perspective, but now I want to buy a house. Now I only earn 17 grand a month and not 20 grand a month, which is a problem. So I dash off to the tissue box squad. Say, please can you confirm my earnings and tell me, because theoretically my total package is still 20 grand, is it not? That's what my worth is. And they write one letter confirming this individual's package is 20 grand and goes into the HR file, SARS picks it up and says invalid salary sacrifice because you've not given up your right to that money. So in other words, that's where the problems come in with these kind of structures, right? You can't have your cake and eat it. Now what happened in this case is they followed exactly the same example that I showed, that I've mentioned to you now. However, the company got greedy. Because they were paying for the vehicle up front, they wanted a return on their income, so they charged interest on that account. So in other words, there was interest deducted from the 3 grand a month that effectively was being paid into that account for the vehicle. Now from a substance over form perspective, what is this? Nothing other than the company has financed your vehicle for you. Because then what did they do next? And whose name was the vehicle registered? The individual. Do you understand the problem? So for that's the reason why they lost that case in one aspect, okay? Now they go through all the paperwork and everything else, you can have a nice look at it, but that's how simple an invalid salary sacrifice can occur, where there's enough precedence to be shown. So in other words, with this in place, they're going to be re-looking at all these company car structures, I guarantee you that, because this is old stuff. I mean, the first company cars were introduced in the late 70s in the mines. That's when it started, this whole scheme. It's not new. I mean, it's been around for years. But with the adaptation through the court cases at the end of the day, things needed to change. So these guys lost on that. All right? Could I argue the point? No. Because you charged interest on it, you financed my vehicle. End of the picture. Okay? That's one aspect of this court case. Another thing, they were giving the individuals cell phones to use. You know, your company cell phones? And they weren't taxing them on any amount. They just said to them, we think you should spend about $500 a month. If it was below 500 Rand a month, they didn't do anything about it. If it was above the 500 Rand a month, the guys would then have to come up with a reason for the expense, but there was no tax payable. None whatsoever. Phone 24/7 available. What did SARS raise? They said, well, the individual hasn't confirmed, and this is where the problems come in with defending a matter. The individual hasn't confirmed, like the 7th schedule now provides, from 2011. Okay? Any company phone or company asset, like a computer, laptop, whatever it might be, your little diskies, you know, data connections, the individual is required to sign that it remains company property, number one, that it's used exclusively for business purposes, and if there's any incidental private use, it will be negligible, and that's a document, and there's no perks tax payable. Okay, that is only from 2011. What tax years are we talking about? 2003 to 2008. SARS raised that argument. Nobody bothered to say to him, excuse me, what did the Act say during 2003, 2004, 2005, 2008? Because you cannot apply 2011's legislation on something for 2008. They lost it. Because they didn't apply their minds correctly. Okay? That's the kind of thing that the significance of what I'm trying to get out of this case. It's well worth it to read it. Because I cannot believe that they didn't see that up front. Because the first thing I would have done is, I would have gone back to my little archives, pulled out 2003 and say, under 7th schedule, where is a company phone a perk? There's no mention of it. Only in 2011, if I don't have that piece of paper, then it becomes a taxable item.